so I'm turning it over to Morley.
Okay. Hello, everybody.
Thanks, Jerry.
I'm going.
Yeah, tonight we don't have anything special to discuss. I've got a couple of topics I could bring up. But you just let me know what else you want to discuss, and if I have any input on it, I'll give it to you, or other people there might have it. But I thought first of all, what would you think is a reasonable expectation for stocks, a portfolio of stocks, percentage-wise?
You mean in terms of
6%.
return?
Yeah, what kind of return? Over a period of time.
6%.
Okay, 6%. Anybody else?
Sounds good.
Historically, the market has done over longer periods of time about 8 to 10% a year. Obviously the last couple of years it's done a lot better than that, but it never goes up a straight, 8 or 10% a year. It will go up, 20%, come back 10%. So a reasonable expectation, if you bought the whole market, should be about, I'd say 8, 9, 10%. What about bonds? What's a reasonable expectation today on bonds?
Sure.
Well, the 10-year treasury was down around 1.25%. So if you bought CDs lately, you're getting a fraction of a percent. It almost doesn't pay to put any money in any of these short-term investments. And cash obviously pays nothing. So I think it's important to know, what kind of returns you expect, because that's how you put your portfolio together. How do you guys figure asset allocation? In other words, how do you determine what the right mix for you is, stocks, bonds, and cash? Anybody participating?
Go on.
Yeah, Mark.
I look to figure out how much cash I would like to take from my bonds or dividend stream, and then I work accordingly with that. Let's say I want to have $50,000 a year in bond interest. And you asked the question. I just bought some bonds. I'm getting about 4%, 4.25%. The Dow Chemical, the Altrias, Western Union. Just recently, unfortunately, bonds keep on being called, and I'm replacing them with 4%ers.
What kind of maturity are you getting for 4%?
A lot of them are what you refer to as the death put bonds, and maturity seems to be 35, 36.
Okay, for 4% on a bond today, it's not a typical bond. It's got to have something to it. When you say you got 4%, that's the coupon 4%?
Yes, I can give you exactly. Yeah.
And what did you pay for it?
I'll give me 1 second and I'll give you the answer. Okay, 1 second. Altria,
Yeah,
which is the tobacco company,
right.
and was offer sheet. Okay.
When did you buy it?
Ross Vegas. From RBC. Ross Vegas. Offer sheet. Here it is.
And what's the coupon?
Okay, here's the latest one as of today. There's Western Union. Coupon is 6.2%, but they're asking 129. Pacific Gas and Electric, 4.45%. The asking is 102. eBay, 115, paying 4%. Boeing, which I bought previously and has come back beautifully, 99, paying 3.5%. Pacific Gas and Electric, which I bought, 4.3%, paying 98.814. In other words, for every 1,000, you pay 98%. Unum Group, which is the insurance company, 4.125, paying 103.85. And then
But when
Altria,
did it- Okay, take the unit. When does that come due?
okay. 6/15 of 2050.
Okay, so that's a long-term bond.
It's a long-term bond. And then here, the Altria, which I bought, which has an A3 rating,
Okay, so
4%.
it's okay if these bonds go down in value, if rates go up, you don't need the money.
I don't care about it because I said to you, it's the amount of money that I look at. And if it's earning 4%, if you take these all together, it still gets me the amount of money. I have no intention of selling these bonds unless they're called.
All right.
Maybe I'm looking at it incorrectly, but that's how I view. A certain amount of my money is there, and then a certain amount of my money is in stock. And the stock money is what I look to appreciate in value, but this is strictly for income.
All right, so, when you say you're getting 4%, you got to look at the yield to maturity, not just the current yield.
Okay, yield to maturity on Altria is 4.07%, even though the bond coupon was 4%.
Okay. Long-term bonds today, to go out, 30, 40 years, if you're not going to sell them, it doesn't matter. But
It doesn't matter, and also they have death put. Many of them have what's called the death put factor.
Yeah, do you know how that works?
Yes, I do. Unfortunately, we took advantage of it.
Okay, but there's a limit. Each year, they only have a certain amount that they'll take back at par. So if a lot of people put in for the death put, you may not get your money back then. So
Right.
you have to wait till the next year. But right now, for the most part, for people who are concerned with the value of the portfolio, the bonds are not a great buy. Now, as long as rates stay low, it's okay. But if the rates start to go up and you need the money or you need to sell the bond, it's going to come down in price. So nothing wrong with what you're doing, but you don't care about the valuation. You just want the income.
That's correct.
Okay, this is a question for everybody else. How well diversified is your portfolio? How do you know how well diversified it is?
Well, if it's managed properly, I mean, some of my portfolio is managed, and I know that I'm a member of AAII, American Association of Individual Investors, and they have some type of a way of assessing the risk of your portfolio to see if you're supposed to have some of you're supposed to have stocks that aren't overlapping. In other words, your portfolio should be diversified, and they give you a risk assessment of if you put in the numbers, the symbols.
I've got a little sheet that I can show you that I use. Can you put me on share screen?
You can share the screen. I'll make you a co-host,
Okay.
Morley. Just 1 second. Okay, you're a co-host. I think you can share your screen.
Okay.
And Barry Weinstein had a question.
Yeah, Barry.
So, I mean, I remember the old saying where you took 110 minus your age, and that's the percentage you should have in stocks, but that doesn't make any sense anymore. I think you have to have a much higher percentage in equities for the very reason that you just spoke about. Bonds are just not very good investments at this point in time, and equities have been much, much better.
Yeah, that formula, like you say, doesn't work today. It used to be if you got 4, 5, 6% on a bond, that was an okay return. Not as good as, let's say, the stock market, but nevertheless, it's still a good return with a lot less risk. Today, you're getting low returns with a lot more risk. If rates go up here, some of these bonds could drop, especially the ones that go way out, 25, 30%. Now, if you just want the income and you don't care, that's one thing. But if you do care about the value of the portfolio, I don't think that fixed income is a place to put a lot of your money. Now, here's a chart that gives you some idea. Equities long-term have grown about 10%. Bonds, I'm putting 3%. It's hard to get 3% without going way out in the maturity spectrum. But here's different mixes. Simple little chart. If you are shooting, let's say, for a 7% return, you need 60 to 70% in stocks to do that. 30 to 40% in bonds. And obviously, if you have no equities and all fixed income, 100% in fixed income, if bonds pay you 3%, that's what you're going to earn. Here's a table that's a little worksheet. If you start out with your portfolio value, whatever that is, let's say it's $1 million. Well, how much do you want to put into stocks? How much do you want to put into bonds? And how much do you want to put into cash? Then in the stocks, you want to have some large cap, mid cap, small cap, and a little bit of international. In the bonds, you want to have a little bit of high yield, some bonds, and money market cash. So this way, this is a really well-diversified portfolio. It's not going to be a portfolio where you're going to do great against the market. You might do a little bit better than the market if it works well, but at least it's well-diversified and you're not going to get hurt badly if the market goes down relative to the market. In other words, if the market goes down, as everybody knows, volatility will take the portfolio down. But with well-diversified, in other words, if you had all of your stuff in large cap, you probably did pretty well the last couple of years. If you had them in small and mid cap, you haven't done as well. So it's good to be, I believe, to participate in these different segments of the market. So you take something like this and you say, all right, let's assume I'm going to put 80% into stocks, 20% into bonds, and really have very little cash. That doesn't mean you shouldn't have cash anywhere, but it shouldn't be in your investment portfolio unless you don't want to put it in stocks or bonds. You should have a certain amount of cash that you have outside of your investments. And that's cash that if you need money quickly, it's there. And then, large cap is the least amount of risk versus these others. Mid cap, a little bit less, more risk. Small cap, more risk. International has the least to it. So these are percentages to put of your money into these different categories. Any questions on this or any comments?
The only thing I would say is that I think you should have municipal bonds in part of the bond because at least you're not paying any taxes.
Well, if you're in the tax bracket where it makes sense, yeah, use municipal bonds instead of government or corporate bonds. And the high yields today are paying about 4 to 5%. Some of them have a little bit more, but they are volatile. But as long as you want the income, you don't worry too much about the volatility. I would use a little bit of high yield, and the way to use high yield is using these closed-end funds. If you try to pick a couple of high yield bonds, you may pick the wrong ones. What you want to do is you want to be in something that's diversified. Maybe they own 50, 60, 70 different high yield bonds. So if one goes bad, it's not a disaster. So that's my thoughts on diversification.
Morley,
Yeah.
would you have a separate chart like this for a retirement account and a non-retirement account?
Well, basically it would be the same if you want to use all of these categories. If we get an account for somebody who's retired, probably 20% in fixed income and 80% in bonds is a little bit on the high side. But a lot depends on whether one is taking money out of the portfolio on a regular basis. It depends on what the purpose of this money is. When you're retired, what's important between, what would you put the most important? Preservation of income, growth, preservation of capital, growth, or income. What do you think the retired person's objective should be? Mainly objective.
Return of my money more than the return on my money.
Yeah.
You think, what do you call it? So what was you saying? What was the most important part? Rank those. You're ranking preservation of capital, number one.
Yeah,
What's number two? Growth or
cash flow.
well, that's income.
Income.
And the third is what? Growth, income, preservation. Okay, so, but let's say we could preserve your capital by buying U.S. treasuries for 0.5%. Does that do the job?
No.
No. So really, I think the first objective should be income. I'm assuming you need to take income out of the portfolio. Of all the clients that we have, I would say probably, 65% need to take income to subsidize other income that they have. So if you're taking income out of the portfolio, that should be the first, your most important factor. Preservation of capital should come second, and third is growth. Anybody agree, disagree?
Agree.
Sounds
Well,
good.
the growth reflects, I mean, if you're taking money out, it depends. If you have enough income and you're not disturbing your initial investment, and that is providing growth on your initial investment. But it's a little more complicated than just because of inflation and the growth of the stock market over the years.
Well, you need growth, and I'll tell you why. In stocks, the income from stocks on a diversified portfolio is probably about 1.5%. If you buy a bond and you go out 2, 3, 4, 5 years, maybe you're going to get 1.5%. So you're not going to get enough income in most cases just from the dividends and the interest. So you need to take some of the growth as part of your payout each year. Because if you just take the income, if you have $1 million, you're talking about $15,000 a year with 1.5%.
I don't know.
So for most people, you say, I need more than that out of my portfolio.
To live in Stonebridge, you certainly do.
And a lot of people, when they get to be in their 70s, let's say in their 80s, they say, well, I really shouldn't take a lot of risk. I shouldn't own a lot of stocks. But if they have enough money that they know they're not going to spend all of this money is going to go usually to children. So you're giving them a portfolio, if you're very conservative, of all bonds and low return type investments. You should look at it from the point of view of the young person. They would want to have growth in the portfolio. So it's okay to have a little bit more equity than you might, have otherwise. Does that make sense? I mean,
No,
no?
no.
Okay, who's saying
First of
no?
all, I'd like to thank Len for inviting me.
Oh, yeah, I'm sorry, Morley, just let me introduce Phil Sloan from the Regency. He runs I invited him.
I did. I don't do it anymore, but I did.
Yeah, he was he ran the investment club at the Regency. And he's very knowledgeable fellow. And I thought that I convinced him that if he had time to join us.
Good. Well,
Yeah.
What don't you agree with?
First of all, it's not one size fits all. I mean,
No,
you're
of course.
talking about a bunch of senior citizens, by and large, if they live in one of our communities. So I think the first thing you have to figure out before you have an investment portfolio is you have to figure out how much money you need to live the way you want to live. And where is that money coming from? Assuming that, you have enough income coming from other sources, that's one person. But if you need money from your portfolio to live the way you want to live, then you have to change the way you think about assets. It's nice to think that assets, stocks do 10% per year, over a very long period of time, which is probably right. It's probably closer to 7 or 8, but I'm not going to argue over points here. But I think that you have to have your own, or your advisor, have to have some sort of outlook as to where you think things are going. You can't, as like Wayne Gretzky once said, you have to go where the puck is going, not where it's been. So going forward here, you would have to make some pretty good assumptions. We haven't had a rising interest rate environment in 40 years, 40. So we're at 0 interest rates or thereabouts. I'm not talking about what the guy before mentioned, I don't know his name, talking about getting 4% coupons on bonds that are going out, 30, 40 years. I'm not talking about that. I'm just talking about, you look at the Treasury yield curve right now, the 10-year is about 130 thereabouts. Most of the Treasury yield curve on an inflation adjusted basis is negative yields right now. If you assume that the inflation rate is what was reported a couple of weeks ago, 4 or 5%, and if you're getting 4%, you're getting negative return. So you're really losing money. So I think that, you have to, and then you have to have risk tolerance. Right now, everybody's sort of giddy and happy. Since 2007, we've pretty much gone straight up. And that's primarily because of the Federal Reserve manipulating the markets, buying $120 billion of bonds a month. Now, how long is that going to continue? Your guess is as good as mine. But if they stop, which is why the market rallied recently, and why the market is nervous now, is because the market is betting that the Fed will continue to, provide liquidity into the markets, and people have nowhere to go. So, I just think there is no one size fits all formulas. You have to talk. Every client is separate, and it's nice that we have all these asset allocation models. And I've been doing this for roughly 55 years. Just to give people that don't know me, I ran the consulting services unit at Merrill Lynch and at Payne Weber. I was head of marketing and asset management. There was an asset management company that sold out to Eaton Vance. We were about an $8 billion company. So, I've been doing this for a long time, and I still do some consulting to some large municipal clients in and around the country. So, and I think right now with bonds, I think the guy that needs income, that's a good source, but be prepared. If we get a real dose of inflation, you could start to see interest rates going up very rapidly.
Right, Phil,
Right
but
now,
let me
the
ask you a
Fed-
question. Phil,
What?
what did I say that you disagree with?
I'm just saying it's not one size fits all. I
Oh,
think
well,
anybody that's 65 or 70 years old or older should not have 80% of their money in stocks.
Let me say something. Maybe I should have said, this was a presentation I made to a group of individuals, not retirees necessarily. So obviously, I'm just showing a way to do it. If you
No, I understand. But what I'm trying to say is that everybody that I know of, and I've seen hundreds of presentations like this, hundreds, believe me, you're making an assumption that we're going to extrapolate returns going out in a straight line. We're not going to have any hiccups. We're not going to have any bumps in the road. We're just going to go straight up.
Yeah, but
Could
I didn't
happen.
do that,
The
Phil.
last 12 years went up, straight up.
I didn't do that. I'm not saying it's going to go up forever at 10%.
Yeah, but how much of it, I look around on its screen here and I see a lot of people as old as I am. And I'm not a spring chicken. And I've been in the business almost 60 years. So you can imagine how old I am. The point that I'm making is, how much risk is anybody willing to take with their money at this stage of their life? If you have a drawdown, 2007 was just an aberration because we bounced back very quickly. But let's go back to 2000, where the NASDAQ went down 80% in 3 years. How many people sitting on this call today would still be in the market? Not many. Because you get scared. If we were 30 years old, we have a lot of years to earn the money back. At this stage of the game, if there's a big hit in the market, you can't earn it back. You're out of money.
But
Then
you
what
can say
happens?
that- You can say that at any time, that anything can happen to the market. So you're right. You have to allocate your assets in the
Yeah,
way,
right.
how much risk can you take? So this is 80% for an individual. Let's take somebody like yourself, who maybe has enough income from outside sources. They don't need income, but they've got three children and 6 grandchildren. Where's
Right.
this money going? Money's
Well,
gonna-
if I don't need income and I'm just, all my money is, I don't have to worry about, my lifestyle, and I don't have to worry about, where, where I'm going to get my money and how I'm not worried about outliving my money. And all my purpose of my money right now is to either give to my children or to charity or whatever, then you're right. Then you might want to do something like this. But if I had concerns about income or concerns about where I may outlive my money, I may have a very different point of view. Let's
take it case.
let me just give one example.
Yeah.
One example, then I'll stop. Then you can do whatever you want. In 1990, which anybody on this call will remember, the #1 market in the world was Japan. And everybody thought that Japan Inc. was going to control the world. They basically, their version of the Dow Jones was 40,000 in 1990. Here we are at 2021. That market is at 28,000. And it's as high now as it's been in the last 20 years or 15 years. So can anybody on this call afford to take 50% hit on the market if it happens? I'm not saying it's going to, but it certainly could. And remember, most people in the market today that are 32 years old or under, let's assume they've been in the market 5, 6, 7 years, 32 years old, have never been in a market that the Fed didn't manipulate. So, I think that at some point, we're going to have to get back to some semblance of normalization where markets function the way they normally function. Right now, you're not getting it. People have nowhere to go. That Tina, there is no alternative. That's what you have now. But how long it lasts, your guess is as good as mine.
All right, Phil, let me give you a typical example. Client comes in, says, I've got $5 million. All right. I need to take out $150,000 a year out of this portfolio.
Okay.
What kind of asset allocation could give him that?
Well, if he comes in with $5 million, he has to take $150,000 out.
Yeah.
Well, that's a very small percentage of the portfolio.
Well, if it's all in treasuries of less than a couple of years, he's not going to get his 3%.
He can't have treasuries. I mean, he can't have it all in treasuries.
No,
I mean, to me, bonds have more risk right now than stocks.
But how would you get him the 3%?
How would I get him to 3%? I would probably get a portfolio of high dividend paying stocks that are high quality.
Okay, so maybe you put what, 50, 60% of the portfolio into those stocks?
I don't know, probably, depending on how much risk the person is willing to take.
Well, I mean, high yield stocks have had their days too, and they didn't do that well.
Yeah, but when I'm talking about high yield stocks, I'm talking about, companies like Altria, as the gentleman mentioned earlier, the stock is probably yielding 5% or 5.5%. That's pretty good yield. Got stocks like Exxon and Chevron. Those dividends are fairly secure, I think. And there's probably a lot of others that, off the top of my head, I can't tell you. But I'm sure if you really sat down and looked at a portfolio of stocks that pay 3 or 4%, you could probably get a reasonable Vodafone yields 6%. AT&T probably yields close to 6%. You could probably put together a pretty good portfolio yielding somewhere between 4 and 6%. You're not going to probably get a lot of growth out of that portfolio. But you don't have a lot of downside risk either.
It wouldn't
because
be.
you have
Don't
yield.
say not a lot of downside risk. I mean, even high yield stock, even stock that have decent yields go down in value.
Oh, of course. But the dividend, if you're at 70 years old or thereabouts, whatever these people are on this call, I would assume that they don't need a lot of income from their portfolio. I'll make that assumption. If they do, then you got a different set of circumstances that you have to deal with. Because I don't think that, because one gentleman said, I want a return on a return of my money, not necessarily a return on my money. And that's a whole different mindset than just a normal person, because he's concerned about risk. He's not willing to take a lot of risk to get more of a return and then have a larger potential to potentially lose money. So, I think that if you have to have some assumptions in your mind as to where the world is going.
And where do you think it's going?
Where do I think it's going? I think eventually the Fed is going to run out of room. And to me, eventually what they're going to do is they're not going to destroy the stock market because the wealth effect in the country would be too great and we'd probably go into somewhat of a depression. They're not going to destroy the bond market by raising rates too far. So, but I think they'll ultimately destroy the dollar. And that's been done several times before. That's where I think the world is going.
What do you mean by destroy the dollar?
Well, I think that the dollar is the reserve currency of the world. And everybody has to have dollars to buy oil or buy copper or buy whatever commodity you want. The world trades in dollars. There's a lot of people in the world that don't want dollars as a method of transport. China clearly doesn't want the world to be running on dollars, and neither does Russia. And I'm sure some of the oil countries like Saudi Arabia would rather have someone other than, have all their money in dollars.
So it'll become more expensive. It'll become more expensive to travel internationally.
It will become more expensive to buy anything. In my opinion, eventually that, oil prices will be adjusted. And if the dollar goes down, oil prices are going higher.
Yep.
Wheat prices are going higher. Copper prices are going higher. Your standard of living in this country will go down.
So people have said this, I've been in this business as long as you've been. And I remember everybody said, when we hit $1 trillion worth of the deficit, we can't function at $1 trillion worth of deficit. The country's going to fall apart. The dollar's not going to go to.
And now it's 30 trillion.
Okay, so now, and every time it got to 2 trillion, they kept saying the same thing.
But just remember one thing, Morley. Right now at 30 trillion, the average interest rates on treasuries is about 1.5%, approximately. Okay, so on 30 trillion, you're talking about $450 billion a year that the U.S. Treasury has to pay out to make those bonds good.
Let me stop you for a second.
What?
Okay, finish your thought. Yeah, I'm sorry.
No, what I was going to say, if the debt is 30 trillion and the average interest rates on treasuries is 1.5%, that's $450 billion in the budget.
Okay, my question then is, where does that money go? That money goes into the economy because 50% of that debt are owned by individuals.
Not treasuries,
Yeah, sure. Who owns the debt?
banks, pension funds, endowments, etc.
All right.
They own a majority of the funds. But the point that I'm making is, you make the assumption that interest rates are going up. Well, for every 1% increase in rates, that's $300 billion.
All right, but I'm saying, doesn't that money come back into the economy in some form?
Maybe it may come into the economy. You don't know how much of the stimulus came into the economy.
I don't know the answer to that.
I don't know the answer to that either. But I do know that savings rates are high. Debt pay downs by the individuals is come down a lot. People have been paying off debts a lot. There isn't a lot of demand for loans right now. So, I think that, we don't know. Right now, I don't know. I don't know what the new normal is going to be. I don't think anybody else does either. Are we going back to where we were before COVID? I have no idea. I don't think so. But what it's going to look like, I don't know either.
Right now, the stock market, in my opinion, is looking at the second half of this year and 2022. And the market's saying, and investors are saying, the economy's coming back nicely.
Absolutely.
And that's why the market's doing well. Now, the market valuation right now, if you look at the S&P 500, it's about 20 times earnings, PE ratio. Now, 20 is historically high, but when
20 times based on what earnings? This year or next year or what?
Based on 2022 earnings.
Okay.
For the S&P, it's about $205 a share.
Okay.
Okay, so You made me lose my thought here for a second. Oh,
I'm
okay.
sorry, I didn't mean to
Wait, no,
interrupt.
I got it back. So it's 20 multiple. If you look back historically, that's the high end of the range for the market.
Mhm.
But in those years when the markets was selling at 20 times earnings, the interest rates on bonds was 4, 5, 6%.
Mhm.
Today, bond rates 1.5% on the 10-year treasury. So nobody knows for sure what's the proper multiple, the high multiple with interest rates at 1.5% on the 10-year treasury. I don't know. But the market seems to think that it's worth, more than 20 times earnings. And in terms of bonds, the Fed could do all it wants, but if you look at supply and demand, there's no big demand to borrow money. Corporations are flush with cash. They've got plenty of capacity to produce more goods and services without making big investments. So that's why I think rates are as low as they are. Are they going to come back, to 4, 5, 6%? Maybe a very, very long time. But in the meantime, people are getting almost nothing on their money for short-term.
Well, I agree. It's a conundrum. I think it's a very difficult environment. And, I'm not saying you're wrong. All I'm saying is most people don't really reflect the risks that are in the markets right now based on historical numbers. I would think that, most of the people that are somewhat cautious on the markets right now are probably people my age or maybe a little bit younger. But I heard Jeremy Siegel today that says that the biggest risk to the market is inflation. Now, I've known Jeremy Siegel for 25 years, and I've almost never, ever heard him say anything bearish. So this is it was like a shock to me personally. But I think he thinks that, inflation is being underpriced in the market. I think right now, most people the last couple of weeks are betting that the Fed is on top of it, that inflation is transitory, and, on we go, no problems.
When was the last time we had too much money flowing out there and not enough goods and services? And that's what, that type of inflation. We've never had the situation where we had too much money out there and not enough goods and services.
Well, we have that now.
We have it now, but we never had it before.
Oh, we had it in the 70s. We haven't had it since then. Ever since Paul Volcker was chairman of the Fed, interest rates have basically come down from 14 or 15% where they were in 1981 to zero, where they are now, approximately. So we haven't had any real inflation for the last 40 years. But what you have now is you have a situation where, things are happening now that you haven't had for a very, very long time. It's very hard to know how it's all going to really play out.
Right.
You can't buy a car today and get delivery tomorrow. Used car prices are the highest they've ever been because you can't get cars. You go out and try to buy appliances today, you're waiting 3-4 months. There's supply chain problems now that we haven't seen, 30, 40 years maybe. So you have labor costs going up, which are going to hit profit margins, and I'm not sure that's being priced in right now. So, I don't know what inflation is ultimately going to look at, but in the next 2 Fed meetings, one in July, and in August they're going to be out in Jackson Hole again. I think you're going to see some action by the Fed to say that inflation is a little higher than they anticipate. That's my own opinion.
Isn't the supply chain problem mostly restricted to computer chips? They can't get the computer chips, but everything else is pretty much okay.
Well, I'll tell you, look at oil, for example, okay? There has never been a time in history where demand outstripped supply. Never. There was always spare capacity somewhere in the world. We're getting very close to the point where supply and demand is going to meet in oil. And Chevron, Exxon, and all the major oil companies have been underinvesting for years now, last 2 or 3 years. They've been buying back stock, they've been paying dividends, but they haven't been really developing oil fields. Well, sooner or later, that comes back to haunt you. If you start to look at production in the United States, I think it peaked at somewhere around 11 or 11.5 million barrels a day. We're probably down to 9 million barrels a day now. I'm not sure you could turn that around real fast, even if you wanted to. And most oil companies are telling you they are not going, even though the prices, I read today, this is an interesting point. Even though prices are around $73, $74 a barrel, most oil companies last year hedged all their oil at $55. So they're selling oil today at $55 that they could have really got a 70 just because they needed cash last year because the prices were so low. So you got situations now that we haven't seen before. You know, it's really hard to know. You know, I think oil is going to scare everybody. I don't think at the beginning of this year, I'm not sure how many people thought you were going to see $3 gas prices. And I'm thinking that by the fourth quarter this year, prices are going to be close to $4.
I guess
And there's
I guess I picked the right time to get an electric car.
Well, you know, I mean, but you know, I think it's a great idea, electric cars and you know, but think about this for a second. We got, I think about 3 or 4% of the car market today is electric. Right? I don't know. I think that's probably a reasonable number.
Small percentage, right?
Small percentage. If we want to get electric cars up and running to you know, where it's a larger percentage of the market, we're going to have to invest trillions of dollars putting in charging stations throughout the country. We're very early in that game.
Forget charging stations, the power generation plants have to be able to keep up too.
Well, 80% of our power currently comes from fossil fuels,
Right?
right? And that's gas, coal, and oil.
Yeah.
China still gets 60% of their power generation from coal.
And they're building a lot more coal plants.
Well, you know, they don't have any choice. I mean, you know, you could build nuclear plants, but they take a long time to build. You know, China made a huge investment in the Three Gorges Dam. And, you know, that was supposed to be, you know, hydropower, getting a tremendous amount. Well, they didn't figure they would have a drought. So, you know, I mean, these are real live problems that, you know, nobody talks about, but, you know, you got coal prices. You know, it's interesting. Coal prices now are at the highest they've been in years. And, you know, the amount of supply is limited. So, you know, again, I don't know, you know, how you deal with the supply chain problems, but my guess is we're going to rebuild manufacturing here in this country.
And
I
the
mean, you know,
Jersey,
Intel, give you an example. You talked about computer chips. Intel, for the last probably 5 or 6, 7 years, 8 years, bought $80 billion worth of stock, didn't build a plant. Now they want to build plants. Well, you can't put up a plant in a week. At $80 billion, the stock is down 50% from 2000 levels. So, you know, I mean, I think that, you know, right now we've had this nirvana in the markets where if you bought index funds, and I you know, I'm not advocating it, but if you bought index funds, you beat just about anything. Just no manager can keep up with the index funds because most of the performance is coming from a very few number of stocks, other than, you know, the Reddit stocks, GameStop, AMC, etc. Those kind of stuff. That's another new phenomenon we've never seen before. So I think that, you know, we're in a transition period now that's, you know, very, very odd to really, you know, sit down and think about where we're going. We just don't know.
So, over the years, bear markets never occur the same way as the previous ones. It's always something different that happens that causes a bear market.
Mhm.
And for the most part, you know, 90% of people don't see it until it really hits you.
Mhm.
So, you know, to try to figure out where the market's going to go and when we're going to have a bad market is very difficult. And, you know, it's like you say, it's almost impossible. What's your percentage of equity in your portfolio?
I'm sorry, mine personally, probably about 100% in equities. I don't own any bonds.
100% in equity?
Yep.
Oh, but you just painted a negative scenario.
But that's me. You know, I understand my risk tolerance. I understand what my financial needs are. I'm more of a gambler because I think I have enough, the wherewithal to just keep going. And if I see a situation where I think it's time to get out, I'll go 100% cash.
Okay.
I just want to comment that I read, I don't know, yesterday or today, that New Jersey is now giving a they've restored the $5,000 rebate on electric cars. Just as a sidebar to what Phil was saying about electric cars.
I mean,
Jerry.
Electric cars are terrific. I haven't, I don't own one, but I think everybody that wants to own one should own one. But it's going to be a long time before they become, what's going to drive the oil market. We still have several 100 million cars in this country that are gas operated. They're not going away anytime soon.
Nope.
The Neo solution to replace the battery that they have it set up, and you go into a garage or whatever it is, and they take the
Neo.
battery out and put a new one in 3 minutes.
Okay.
Yeah, that's in China.
Okay. If you believe what's coming out of China.
Yeah, no, well, that's what their technology is. Instead of using charging stations, they have battery.
What about batteries?
Okay.
Yeah.
I've been investing in a lot of stocks that support the electric car market, not necessarily a particular brand, although I own Tesla. But I've been investing in stocks like an equity fund like iDrive, IDRV, Neo, Workhorse, stocks like that.
Okay.
I came from the technology field, and I just feel that that's the way to go. And UBS says that by 2040, virtually every car will be electric.
That's 20 years from now.
That's okay. It's going to build.
Okay. Well,
Think
that's
about
okay.
Amazon
as
20
long
years
as,
ago.
I commend you. I mean, as long as you understand that you're taking a pretty good risk in your portfolio, as long as you understand that, that's fine.
It's not a big piece of my portfolio.
Okay, then
It's-
it's fine.
It's the play part of the portfolio. I don't count it as solid.
Oh,
It's my gamble part of the portfolio, but it is something I believe in.
Okay, then you should do it.
So I did.
Good.
There
I
any
think
industry-
covered calls it. Morley, do you talk about covered calls with potentially your clients or whatever?
Very few, because it's difficult for them to understand it.
Really?
I find that if you sell a call on a stock, if you put it way above where the stock price is, you're getting nickels and dimes. If the stock happens to do well, and I assume that you like the stock and you think it's going to do well, it can get called away easily. So I don't do that as with many clients. No. Why, do you like that philosophy?
I think covered call is an income generating type of, stock portfolio.
It is, but you take the risk of losing a stock that you may not want to lose.
Well, the cost of the transaction cost today is so low that if it happens, you could replace the stock and do it again. I mean, years ago when commissions were relatively high, then it made a difference. But now the cost of buying a stock back, very, very, very little.
Yeah, but if it goes to, let's say you got a $20 stock and you sell a $25 call and the stock goes to 30. Now you got to buy the stock back at 30.
Well, I mean, if I don't think you close your eyes and say, I'm going to sell a call and then just forget about it and not watch the portfolio. I mean, you got, if you have to have points where you say, this is not working the way I want and I got to change direction. But,
it's still going the wrong way.
Well, look, I mean, I think everybody has their own opinions and I don't think anybody's wrong, anybody's right. I mean, I don't think anybody has a crystal ball, but, I think that for people that are our age looking for income, covered call writing is something they should look at. That's all. And they should talk to their financial advisor, whoever that may be, about that as a potential part of a strategy for part of your portfolio.
So when you do your covered calls, do you do them in taxable accounts or tax deferred accounts?
This is you, but you don't.
Well, I don't want to get into tax situations. I'm not an accountant. But I think that everybody has to evaluate their own tax position.
But otherwise, it's like ordinary income if you do it in a short term in a taxable account.
Well, then any income you're going to get, dividends are also taxable, right?
Well, they're treated differently because you have, dividends have a separate tax category.
Okay, so when you look at a covered call, option writing program, then you look at the after-tax effects of the income. Then you make a decision whether that's a good strategy or not a good strategy.
I've done a lot of covered call writing, but it's almost always in my retirement accounts.
Okay, well, then there's no tax consequences. But what I'm saying is every investment requires some thought process as to how it's going to affect your taxes and how it's not. But you should never make this investment decisions based on taxes. Don't sell a stock now because you're going to have to pay taxes and then watch the stock go back down. I mean, that doesn't make a lot of sense either. So, but everybody has to do their own homework. There's no one decision stocks, no one decision anything. That's that point I get across. Think about if you're going to be an investor, treat it like you treated your business, that it's important that you look at it, you watch it, you want to make sure that you stay on track to whatever your goals and objectives are. And if things are going awry, you have to make a decision. You just can't ignore it. We've been very fortunate for the last 6 or 7 years, or probably 12 years since 2008. We've been very, very fortunate because the Federal Reserve has been our back, by buying all these bonds and pouring billions and billions in money into the markets every year, and the markets have gone higher. Will that continue? I don't know. I don't think anybody knows. It's an experiment, and we'll see if it worked out or not.
Hard to imagine interest rates aren't going to be significantly higher in 2 years. So I don't know how you can hold long-term bonds. That's my view, but other people have different views. But I don't think anybody really knows.
Well,
I think if the economy starts to tank, and I certainly hope it doesn't, but I think if the economy starts to slow down at all, the Fed will be there buying more bonds than they ever will, which I think the Fed balance sheet right now is $8 trillion approximately. And I think that if things start going awry in the US stock market, the Fed's balance sheet will go to 15 trillion. That's my own opinion.
Well, this is an interesting exchange, very informative. Are there any other questions?
Len, take me off that share. I'm trying to get back to the.
Oh, okay. Let me, okay, 1 second. You can stop sharing your screen. That's what you can do.
I'm looking. Okay, here you go. I found it. Okay.
Yeah, there you go.
Okay. I just want to say that the illustration I showed was not a recommendation to have 80%. Everybody should have 80% in stocks. What Phil's saying is right. Everybody has different asset allocation depending on their age, their needs, their risk tolerance. There's a lot of factors that go into it. So I don't want anybody to think that I'm recommending that you should have 80% of your money in stocks. I think that at your age or our age, you should have some percentage, and at least a 30-35% exposure to stocks. If you're very risk averse, is not a big risk that you're taking.
Are there any other questions? Steve Birnbaum, you've been very quiet. I'm putting you on the spot.
Yeah. Morley, let me ask you a question. Client comes in, $1 million, $2 million, $5 million. Do you evaluate if their money's going to last their lifetime? I mean,
Right.
we're not going to live to 150. So, you know, if somebody comes in at 60, they have certainly a projected lifespan. But if somebody comes in at 70 or 75, they also have a projected lifespan. So if somebody comes in and clearly the money will last their life, there's no way they're going to run out, even if the market goes down. Let's assume they have cash. So where do you put that money? Do you do your same allocation?
Well, if they don't need income out of the portfolio.
Right, at
let's say
all.
75 years old. It's a question then of, what's the money for? Okay.
Children, right?
Okay, for their children, all right?
Right.
So you're going to build a portfolio for your children. What kind of portfolio would you build? Would you build it with, mostly bonds and very little stocks for growth? I mean, probably not. And then, you can, as long as you can take the volatility, you could own as much stock as you want in that portfolio.
Right.
I never recommend that somebody put 100% of their money in stocks. I think there was a study done many years ago that said if you've got 75% stocks and 25% bonds, you will do just as well over time than if you had 100% in stocks. And I'm not sure if that's true today, but I think it's pretty close.
What do you say, Phil?
I agree with him.
Okay. Well, in a
I mean,
case like that, right?
The,
In a case like that.
the point that you made, Steve, is that you're bringing up an example of somebody that says, comes in with $5 million. The one question I would ask is how much money you need to live a year the way you want to live. That comes into it because everybody on this screen has different needs. Everybody has a different budget for their year, but most people don't think about it. I may need 200 grand a year to live the way I want to live. Other people may need $50,000 a year. So that has to factor in as to how you can allocate your money. The last thing you want to do is change your lifestyle, believe me. That's I had to give that message to people at some point in time, but in reality, that's the last thing you want to do. So, you got to figure out how long you think you're going to live, which is, sort of morbid to think about it, but we really have to think about it. And how much money you're going to need to live on a year, I think is a reasonable question to think about. And because only you know what you need to live the way you want to live and how you're going to use your money. And then comes your investments.
Are there models out there that you can use?
I'm sure there are.
Yeah. For instance, let's make an assumption that a person at 70 or at 65 or 70 has income, but based on inflation, the buying power is going to drop. We know that, but where inflation comes in. So let's assume they have pensions and it takes care of 80% of their needs right now. Well, later on, it's going to be, 90, 70 and 60 and 50 is going to keep dropping because your buying power drops. So having a model, knowing how long your money will last, cash I'm talking about, or after your income dwindles because of the buying power, there's got to be a model out there that keeps you.
I would say there may be a model. I don't know if there is or there isn't, right. But I would certainly suggest that if you want to develop a model, look at it every year and update it. And if things change your model.
Well, I've used models on that, and you could change it daily, monthly, yearly. You can look at it as often as you want because it makes some assumptions for inflation. That's the killer, the inflation.
We have a model that we put together. It's a very simple model.
Mm-hmm.
It says, here's the asset allocation, whatever it is. We make estimates of the returns for those type of investments. And when we're doing this, we assume the stock market's like 6%. So we want to be conservative. So we then to say, how much income do you have coming in other than investment income? So let's take the case the guy's got 5 million and he needs 150. So let's say you got $50,000 in Social Security, pension, whatever. So you need 100,000 from the portfolio. 100,000 over 5 million is about 2%. So we say, you know what? There's a good chance you're going to be able to do what you want to do. And we show the amount that you take out each year and we adjust that for inflation. Right now we're using 2%. So if you want to see that model and you want me to run something for you, I'd be happy to do that.
Thank you.
Are there any other questions. I appreciate everyone coming to the meeting.
I have one other question.
Sure.
Is there any, with the electric car industry that we briefly discussed, and the grid keeping up with everybody plugging in at the same time? I'm an electrician, by the way, so that's a huge problem, the grid. But besides that, right now, cars, as they become obsolete, you junk them. Steel, materials. As electric cars get junked, you got to deal with those batteries, these lithium batteries that are in these cars, or these NiCads that are in these cars. Is there an industry that's dealing with that? Because as cars build up, right now it's, what do we say, 1%, 2% or something like that of the cars?
No more than 4%.
4%? Yeah, so what happens when they become 10, 15, 20 and the older cars start going into the junkyards? Talk about nuclear waste? What are they going to do with this stuff?
At least it's not radioactive.
Well, that's true. However, what businesses are out there that we can invest in and make money on that?
They're talking about hydrogen batteries.
Well, yeah, that'll take the battery need off the market. Yeah, but it'll also change the model. You buy a Tesla, you're not going to be able to replace the batteries. You're going to have to junk the car and get a car with hydrogen batteries.
Well, they may be able to modify it to go to hydrogen batteries.
Could be. The person who suggested that the batteries be replaced, like in China, they're saying, that was a model in popular mechanics probably in the 70s. That you pull into a gas station, a battery gets dropped out the bottom, new one put in, and you drive away. Problem is the technology wasn't there then. Now the chassis of the car is the battery. Without the battery, the car falls apart. The entire chassis is the battery, glued together. So it's a problem. It's certainly going to be an issue down the road, and I'm sure there's a company out there that's going to make money on it. I want to know that company.
I mean, right now, in my opinion, anyway, electric cars are a nice, image of things to come. We're a long way away from them becoming, I think the person, I don't know who was talking about the electricity grid. I think we have to replace the entire electricity grid in the United States.
I don't think it's all that long, only because every major car manufacturer is
Right.
claiming that by 2035 or so, they will only be producing electric cars. So it's not that far off.
But if
But that's
Jerry, you
15
gotta
years.
remember
Now
that-
look at the age of the people on this
Right.
screen.
Right.
15 years from now, some of us may not be.
But on a societal
But we're
basis,
talking about an
it's not that
industry.
far off.
Right.
Yeah, but we've had industries like this before. In 2000, we had all these companies that were producing computers, right? Sun Microsystems. We had Compaq Computer. We had Atari. We had, how many companies were doing all this stuff? Fine. So who is going to be around? What companies are going to be around in 2035? I haven't got a clue.
Right.
We'll all be driving steam engines.
Yeah.
Well, look, I mean, but look what happened in Texas this year with the electricity grid. I mean, so, but nobody talks about it. We haven't done anything in this country on an electricity grid, I don't know, 30, 40, 50 years.
That's right. Phil,
And whoever, there are parts of this country now that run out of power just powering computers, forgetting about electric cars, forgetting about all the other stuff.
the
can't
Bitcoin
even-
computers,
Get all this stuff on laptops. We have blackouts.
the Bitcoin computers are causing a huge problem
Yeah, well,
on the grid.
yeah, maybe. I'm not so sure about that.
Well, up in Montana, they just built a 105 megawatt plant just for a factory of the computers that produce Bitcoin. The
Okay.
problem is that Montana plant is oil. I think no, it's natural gas. So we're going right back to the
Most of the Bitcoin miners or whatever miners
China.
there are, they try to go to places where electricity is plentiful and cheap.
But that changes very quickly as soon as they start drawing.
Well,
the
I
people in the-
don't know how many people are actually doing it. I mean,
It's a lot.
well, maybe, I don't know, maybe.
I mean, they've already banned them. They've already shut down factories where they set up camp next to a power plant, and then the other people's rates went up. They screamed bloody murder, and they shut down the plants. So they're moving around. They keep moving
Well,
around.
look at people in the financial services industry,
Mhm.
you know, the high frequency traders.
Yeah.
They locate their offices so they can get an extra nanosecond to beat orders to the floor.
Yep. Yep.
You know, they look at where they could, you know, where they should be, you know, between New York and, I don't know, somewhere in New Jersey, where they can get a faster throughput on electricity.
Yep.
I mean, that's beyond most people, certainly beyond me. But there's a lot of people trying to figure this stuff out. It's still early in the game in all of these industries.
Phil, what do you know about the carbon credits for the electric car?
I don't really know a lot about it yet.
Right.
All I know is that Exxon wants that to be a major industry. So you can bet it's going to be good for oil companies.
Well, yeah. I don't know if you know it, but Tesla's $500 million in profit came straight from carbon credits.
They don't make any
Selling.
money on their cars.
Yeah, they're not making a dime on their cars. They're
Right.
selling carbon credits.
Right.
But as General Motors starts making electric cars, Jerry, you mentioned it, you know, the amount of cars
Right.
that are being
Right.
made, they cannot build fossil fuel cars because the government's carbon credits.
Right. Well,
Every
you know, but that's still that industry is still, I don't even know if it's even in its infancy yet.
But you got to remember, that's why the drive to SUVs happened, because they're called trucks and they don't have to be in the government's,
Right.
you know, gas mileage, you know, EPA stuff. That's why you're not having sedans being built. That's one of the reasons. And the
Well,
second
Ford
reason
doesn't make any cars anymore.
Yeah, exactly. So it's being driven by policy. A lot of this stuff is being driven by policy.
Yeah, but if we ever have $4 gas or $4.50 gas, I don't know how many people are going to be buying those big trucks.
Well, it happened before. We've seen
It
it.
happened before.
Yeah.
That gave Toyota an entry into the country in the 70s.
Yep, absolutely. Yep.
But, you know, look, you can't find truck drivers today. Gasoline is going to go up primarily because you can't find people that drive gasoline trucks. There's a 25% shortage of gasoline truck drivers.
Anybody here need a job?
Anybody need a job? They pay pretty good.
Well, what's going to happen if you get mostly, you know, a lot of electric cars on the road and the environment doesn't clean up any?
Well, there you go. I don't know.
What do you mean?
You know,
What
I
do you
mean,
mean the
you
environment?
know, I just I'll throw something out. You know, we're talking about renewable energy, and this is not a political statement, believe me. We talk about the wind power, right? You know, does anybody know that those wind turbines last about 10 years and then they have to be replaced? What are you going to do with all those wind turbines?
Well, what has to be replaced? The turbine itself, not the
Propellers.
entire structure,
Propellers.
the blades.
Yep.
Yeah, so
That's
there are replaceable
that's a
parts.
major problem.
Yep.
And, you know, but nobody talks about it. I mean, you know, I'm all for, you know, solar power, wind power, any kind of power you can get.
Well,
But,
nobody
you know,
talks about the fact that all these wind turbines are actually slowing down the rotation of the earth.
I
They're
couldn't
going
tell
in the
you.
wrong direction.
But, you know, look, I mean, we live in interesting times. And I think that one of the things about a group like this is that people think. I mean, you know, they imagine, they think about the future. I mean, forgetting about your own money, which you certainly think about, but you have, you know, you come up with some ideas about where things are going. At least as an investor, you should.
So Phil, you mentioned the environment and whether it's going to help the environment or whatever. So in 2020, the world came to a standstill. Planes didn't fly, cars didn't drive.
Right.
So you would think that greenhouse emissions, that the atmosphere, the carbon load on the atmosphere would have come down. It's only a logical assumption. Instead, it continued to go up.
Well,
So-
you know, the whole world didn't. I mean, Asia didn't really slow down a lot.
Mhm.
China didn't slow down. They didn't shut down, not
Yeah.
like we did. I mean, I mean, I would think that this climate issue is a long-term issue that we're gonna have to deal with sooner or later. I mean, the temperatures,
It better be sooner.
it better be sooner, right? But
Otherwise,
it's not going, unfortunately, it's not going.
We wouldn't have
it's
to
not
worry
going
about
to.
investments.
Right. But I mean, the thing about the temperatures in the West Coast this year, 115 degrees in places that never saw temperatures anywhere close to that.
I mean, look at the temperatures today and yesterday. We're having August temperatures in July.
Right, right.
That's just going to continue.
Well, but yet all our power plants are all fossil fuels right now.
That's right.
We're not building any nuclear plants. I think there's one being built in Georgia, maybe, or Tennessee.
Yeah.
There's one proposed in Wyoming. I mean, that's a pretty, other than 3 minor accidents, all of which could have been prevented had it, they've been done right. We should be having a lot more nuclear power right now.
Yeah, I agree with that. Even if we have a minor situation now and again, that's better than the entire world going out, which is what will happen with climate change.
Well,
Well,
I agree with you.
It's not in my backyard.
Well, that's another problem.
That's a huge problem for nuclear.
Well, look, they shut down Indian Point in New York, and they didn't replace it with anything.
What about Long Island? Sure.
Long
I mean,
Island,
they never
right.
put it online. So,
Right.
that was an $8 billion experiment. So.
Well, so I mean, when these things shut down, everybody yells, "Yay!" What are you going to replace it with?
That's right. There's, all of this is an interesting conversation, but everything that we're discussing is only a long-term finger in the dike. The only thing that'll save us is we have to figure out how to make it work and commercialize fusion technology. And if
We've
we
been
can't
working
get
on that
fusion,
for as far back as I can
can't tell you
remember.
how long. But if we can't get it to work, forget it. It's all
What
over.
was that? They had that big plant down at Princeton University, Tomac.
The tokamak. I visited.
Tokamak.
I actually visited and talked to the physicists 20 years ago, and they said that the politicians are making promises, and they still have no idea how this stuff works, but yet the politicians are making promises.
Well, that's fusion would ultimately be a great answer, but I'm not sure we'll see it in our lifetime.
Yeah, I know.
You know what, let me just say something here, that we tend to do the following. We tend to take a problem and we extrapolate the problem. And we hold the solutions constant. In other words,
You're right.
solutions will be,
Well, if we don't find a solution, the problem will take care of itself. So,
Well, the problem's going to take care of it. The problem's going to take care of itself when the Earth goes into the sun. Also, it's going to happen. But it depends on how many billions of years you're looking to, into the future. So.
Yeah, I have one question, and maybe the meeting is 8:19, which is maybe losing interest. But what's your thought on, from an investment technique, using artificial intelligence software?
I don't know really enough about it, to be honest with you. I mean, they've done some marvelous things with artificial intelligence. I'm not, clearly I don't really know that much about it, but I know China's way ahead of us.
I've got an answer for you, Lenny.
Okay.
IBM came up with a computer called Watson.
Right.
Watson played these games with different Jeopardy and all these other games and beat everybody. I'm sure that they tried to use Watson to figure out the stock market. So if Watson can't figure it out, we're not going to figure it out.
I think that as of right now, there's nothing going to replace the human mind.
Did they have monkeys throwing darts at one time and did better?
Yes, they did do that.
Yeah.
At the Wall Street Journal, they had a monkey throwing darts at the Wall Street Journal.
Right.
But we're almost in a position like that right now. The S&P 500 has beaten most mutual funds, most asset managers for the last 5 or 6 or 7 years. That's unheard of. The market is very skewed in, for certain stocks. Now, if that changes, and it will change, be careful.
Bill, remember the Nifty 50, right?
Yes, I do.
That was when, you could buy stock, pay any price, and it's okay, it's gonna keep going up.
Well,
And
those stocks were the Nifty 50, and how many of those Nifty 50s are still around? Not many.
Kodak, Xerox, IBM.
Simplicity Pattern was one
Yeah.
of the Nifty 50. But that started a bear market that went on for 10 years.
But
My favorite quote from the Wall Street Journal, Phil, was "Ain't no free lunch."
There's nothing could be better said, Len.
Yeah. All right, look, I don't want to take advantage of you guys and ladies, Barbara. If there are any other questions, we can address them, but I think it's 8:22 and maybe we'll call it a night. Unless someone has, I'm recording this and my MO is I give the flash drive after it's recorded to Steve and he does his magic and then I upload it onto YouTube. So Phil, thank you for coming. I appreciate it. We enjoyed
Thank you for inviting me.
your
Thank you,
interaction.
gentlemen.
As long as I didn't have to prepare a presentation, I'm more than happy to participate.
Thank you. And Morley, thank you for helping. you know.
Thanks, Molly. I'm sorry. I didn't mean to interrupt your.
No, you're not. Normally we have Mike Bauer here also. And so I'm happy that you could come and add to our discussion.
Okay.
I think that we'll just call it a night.